Do you know the answer to this question? What is an investment? If you said yes, then you can pick out the investment from the following: a lottery ticket, the car I bought for my daily commute, or a 401k. The answer? None of the above. Stay tuned. What is and is not an investment? Coming up. It's Jeff Drayton, Certified Financial Planner Professional and founder of Jeffrey A. Drayton Financial Planning and Wealth Management, LLC. If you're watching this on YouTube, go ahead and subscribe. And if you're viewing this from the blog page of my website, fill out the contact form at the top of that page so that we can contact you when new content becomes available. You know, frequently in the things I hear people say or in the advice that I see given by this or that investment guru, I can tell that there's a fair amount of confusion as to what exactly it is that constitutes an investment. And although my definition might not be the same as what you find in a dictionary, the question as to what an investment is a valid one. You should understand, at least on a basic level, what it is that you are buying when you are purchasing an investment. And a starting point for all investments is, what the heck is an investment in the first place? So first up, a definition. An investment is something that will give you at least a reasonable expectation, albeit with some risk, that you will receive a return. Among the most common types of investments that average investors make are two that I have discussed before: equity and debt, which are frequently in the form of stocks and bonds. If you do not know exactly what it is that you own in purchasing a stock or a bond, or a fund that contains them, I would recommend watching a previous video of mine that I will tag above and link below. However, the executive summary is this: when you purchase stock, you are becoming a part owner of a company. Since another term for ownership is equity, this name is frequently used to refer to stock. When you purchase a bond, you are lending money to whatever entity it was that issued that bond. You are a lender and they have borrowed money from you. Hence, bonds are commonly referred to as debt. Now, certainly stocks and bonds are not the only two types of investments that exist. However, both have something in common with that which is often typical of investments. They basically have no function or benefit in your life other than to hopefully produce an investment return. Meaning, you can't eat stocks and bonds, they can't be used as a roof over your head. They are investments, pure and simple. Their only purpose to the investor is to hopefully produce an investment return. It is possible to make investments in items that could produce a benefit beyond just the potential for an investment gain. An example here might be collectibles, things like art or coins or even baseball cards or classic cars. These items can be purchased with the intent of trying to produce a return through their appreciation in value, and yet have the side benefit of being something that the investor might take pleasure in owning, at least if that is something in which they have an interest. As a matter of fact, having an interest in a particular collectible is a very good idea if it is something in which you are going to invest. Collectibles are quite speculative, and expertise in the type of collectible in which you are choosing to invest would be highly recommended. However, there are some challenges in investing in collectibles. First up, since unlike stocks and bonds, these are physical items, they will likely need to be stored and insured. A collection of classic cars or rare coins is going to need a secure place in which to keep it. And then there's the question of taxes. Most investments that achieve their return through an appreciation in value qualify for what is called capital gains tax treatment. The exact rate that the gain will be taxed at is dependent on your income, but it's generally either 0, 15, or 20%, and is more favorable than your marginal ordinary income tax rate. Collectibles are an exception to this. Their capital gains rate is 28%. So, not quite as nice. Something you can generally consider to not be an investment is likely anything that is providing a function for you in your daily life, which is to say, the antithesis of a stock or a bond. Recently, I did a video on the topic of purchasing a car, and a comment that I got more than once was, "Don't buy a new car, they're a horrible investment." Well, guess what? A car that you are purchasing for transportation isn't actually an investment at all. Cars are a consumable. They are a depreciating asset that have a useful life expectancy, a life expectancy that you are using up as you drive that car to fulfill your transportation needs. Cars are no more an investment than are the groceries you buy to feed yourself each week. There are more economical ways to purchase and own a car, the same way there are more economical ways to buy groceries, but at the end of the day, they're an expense, not an investment. One possible exception to this principle that investments are generally not things that are fulfilling a need in your life is your home. Real estate is an investment class, and it is something that one could reasonably expect to appreciate in value. And many people do increase their net worth over time through the purchase of a home. So, an investment. Real estate as an investment class has a few characteristics that you should be aware of, namely high transaction costs. It costs a lot to buy and sell real estate, and it is fairly volatile. Like stocks, the real estate market is prone to significant swings in value. Both of those characteristics generally favor holding a piece of real estate that you own for a fairly long time. A long holding period allows an investment time to make up the expense of the transaction cost it took to purchase it, and it also provides an opportunity to even out the volatility of that asset's market price. However, the fact that your personal residence is providing you with a need in your life, a place to live, points to why this is something that is generally not a characteristic of an investment. Reason being, when this is the case, it is very difficult to harvest your investment gain when that asset does appreciate in value. What do I mean by this? Let me give you an example. Imagine I bought a house several years ago for $100,000. Now my home is worth $300,000. Lucky for me, I have a $200,000 capital gain. So I decide to sell my house and realize that gain. But now I've got a problem. Where am I going to live? If I decide I want a house that is at least as nice as the one I just sold, well, I know exactly how much that is going to cost. $300,000. I'm right back where I started. Now, truthfully, some people do realize a gain on their home at some point in their life. It's not uncommon for older couples to downsize when their children have grown and they no longer have the need for a home that is as large as the one in which they raised a family. The tax code even has a nice provision exempting your home from capital gains tax up to a limit. However, the point is generally valid. Investments are typically things that one purchases to put their money to work, savings that you are currently not using. They are generally not the things you purchase as the necessities of your life. A couple of final points. A comment I hear with some frequency, or a question I sometimes get asked is a 401k a good investment? Or, what kind of a return can I get on a Roth IRA? 401ks, Roth IRAs, brokerage accounts, or anything of the like are not investments. They are plans or accounts that hold investments. Asking the question, can I get a good return on a 401k, is somewhat akin to going to a grocery store and asking an employee, which shopping cart should I choose if I want my family to eat healthy food this week? The health of the food is not dependent on the shopping cart. It is a function of the groceries you select to put into that cart. So too is the case with your brokerage account or retirement plan. My analogy is not perfect in that selecting the proper account for your investments can impact your overall return, generally as the result of taxes. So in that case, the shopping cart does matter. I spoke about this in a video from a few weeks back titled Types of Accounts and Their Uses. Again, I'll put a card above and a link below. But for the actual investment return, you are going to want to know and understand the investments that you are selecting to put into that account. The stocks, bonds, mutual funds, ETFs, whatever it is that you are investing in to hopefully create your investment gain. Those are investments. The account you put them in is not. Lastly, investing is not gambling, or at least it shouldn't be. Almost all the principles of investing work exactly opposite when applied to gambling. Markets tend to go up, but this is only true in the long term. The short term is virtually anybody's guess. So you should have a long-term approach. You should keep your investment dollars in the market for as long of a time horizon as is possible given your goals. And you should diversify your investments so that you are not overly exposed to any one asset in your portfolio. These principles take advantage of the fact that in investing over long time periods, the odds are with you. However, neither of these principles work in gambling. Why? Because in gambling, the odds are not with you. They're against you. Sitting at the roulette table for an extended period of time and making bets all over the board just means you're about certain to lose, which is basically a true statement of gambling in general. So buying that lottery ticket thinking that is how you are going to achieve wealth is most likely a suspect plan. If you have questions about the investments that you are making in your investment portfolio, I highly recommend that you speak to your, hopefully, certified financial planner professional. I'm Jeff Drayton. Thanks for watching. Hey everyone, as always, nothing in this video is meant to be specific advice for you. Advice like that can only be had by working with a financial planner, someone who knows you and your situation. I would encourage you to seek out someone who is a certified financial planner. This is signified by the letter CFP with a registered trademark sign following his or her name. I would also encourage you to work with a fee-only financial planner. Now that's two words, fee-only, not fee-based, not fee plus commission. Both of those terms mean that the planner or advisor can receive commissions and is therefore not free of the conflict of interest inherent to commission sales. Again, I'm Jeff Drayton. Thanks for watching.